Good morning, everybody. Excited about presenting you our opinion of the local retail market. For those of you that don't know me, my partner is Jeff Reed. We're both native Houstonians, and we graduated from Baylor University. And in 1991, we formed Reed King, and it was primarily a tenant representation and investment sales company. We grew into a small boutique development company, and within about an 8-year period starting in 2000, we developed over 2 million square feet of Class A anchored retail space. In 2008, we redefined our company and modified it into a full-service company offering third-party management and leasing, tenant representation, dispositions, and construction and development services. So you can go to our website and find out more about our company. Let me see how to use this thing. Is it wrong one? Okay, there we go. The state of the local economy. I've had a lot of people ask me, how does this compare to the mid-'80s? And my first reaction is, I'm not that old. But actually, I was around back then. And so back then it was a real estate depression. It was so overbuilt. There was such a large overhang as it compared today. I think we learned some things back then. And overbuilding was one of the main things we learned. I would say, in general, Houston and the state of Texas, it's not a boom state or a bust state. Oh, that one there. And some of this has already been recited today, but I'll go through quickly some of the macro economics here. There's been over 1 million people population growth in the last decade, which ranks third nationally. Our unemployment rate is consistently been below the national level. And then in the last 5 years, we're #1 in employment gains. And what makes Houston tick? The number of things. Obviously, there's 25 Fortune 500 companies headquartered here. And then the key drivers to our economy, the Texas Medical Center, the largest one in the world, the Port of Houston, which Welcome described very well. Again, energy capital of the world, and then a pro-business environment here in Houston. Now let's get into, I guess what you want to hear is about the retail markets here in Houston. Our total market, and all this information came from CoStar, our total market area and square footage is over 300 million square feet, and it's divided up into 4 categories. 2/3 of our market is concentrated in neighborhood centers, which are grocery-anchored centers by definition, and community centers, which include power centers, lifestyle centers, outlet centers, and then the balance of it's in regional malls, excuse me, and strip centers, and strip centers are unanchored, and it's unfortunate we have too many of those. Our occupancy rates, it's interesting, they're sitting at 92.2%, which is the highest level since 2005, although it's still below the 8-year average. And leading that occupancy is inside the Loop in the west side of town. As far as market rents, we're averaging $14.38, and that's been trending down for the last 5 years. But it's still above the 8-year average, and we feel that they've bottomed out this year, and we look for a gradual increase in rents next year. And absorption is an interesting tale. 2008, we peaked in completions at about 8 million square feet, and in the last 12 months, we're less than 2 million feet. And in the last 12 months, we've absorbed over 5 million square feet. So the positive absorption is a good thing. There's leasing activity right now. The last 6 months has really picked up, and also we've had limited development. This is a little chart on the holiday sales. This is interesting. Nationally, we're projecting about a 3% growth nationally on holiday sales. Now, I understand through some sources here in Houston that number could double. Could be more like 6% here. And another interesting fact is Cyber Monday hit an all-time record of over $1 billion in sales, and that represents a 16% increase over previous years. And so I think that's going to continue that trend. I think the internet is definitely changing the retail business, and retailers are going to have to get creative on how they market themselves. And now we're going into, excuse me, changing market conditions. In the last couple of years, really the only active tenants have been the discount and value-oriented retailers. And also, we've done quite a bit of non-traditional leasing. Medical tenants have been very active, wanting storefronts and retail centers. I'm sure y'all have noticed that almost on every corner we have a minor emergency care center. So I guess as we age, we can go down to the next corner and admit ourselves, and they'll take us off on an ambulance somewhere. So anyway, so there's been a flight to quality from B to A. Just like in any down market, tenants are able to upgrade their locations for relatively the same price. And so we've seen that quite a bit. On publicly traded retail companies, it's really interesting. They've become very healthy. They've reset their balance sheets, and they've been really focused on their stores, within their stores. They've reduced the size of their stores. They've become more efficient. They've been cutting operating expenses, and they've limited capital expenditures for new stores. They're managing their inventory levels better, and they're remodeling and reformatting stores. So they've been really internally clean shop, and they're actually creating a lot of cash. So they're sitting on cash, and they're fairly healthy across the board. For instance, I would say on the reformatting situation, Target has got, they're going to reformat 9 stores here in Houston that don't have a grocery component, and they're going to change them into what they call P-Fresh concepts, which they'll add 15 to 20,000 feet of grocery store in their store to increase sales. And again, going back to Cyber Monday, there's been an emphasis in the last few years on increase in internet sales. Some emerging trends. Investment sales have been very interesting. Earlier this year, grocery-anchored shopping centers were trading, let's say, in the high 8s, low 9 cap rate. And actually in 2009, when the world thought we were going to all fall off the world, those things were going at 9.5. But since the beginning of the year, there's been a cap rate compression of at least 100 to 150 basis points for the same things that traded at the beginning of the year. I don't see Mark here today, but Weingarten Realty just purchased a percentage of ownership of the HEB at Bunker Hill and I-10, and that was just closed recently, and that closed under a 7 cap. So it's a very healthy market, very competitive on the high end, on the top end, on the trophy properties. There's a lot of competition from lenders loaning money to them, and also for the buyers, and mainly REITs, mainly institutional. But once you get out of the trophy property arena, then there's a pretty big gap between what people are asking for and what people are willing to pay. Distressed properties, they really haven't had that many foreclosures in our business yet, and there still remains a sizable bid-ask price there. We feel like next year that we'll start seeing banks starting to get pressure from the feds to start cleaning up their balance sheets and either selling their REO or their non-performing loans. On new development, it's difficult at best, and you've got to have significant pre-leasing. You have to have substantial equity. I would say back a few years ago, if you had a grocery store and a few pad users, you could pretty much go to a bank, and for little or no equity, you could get a construction loan and move forward. And today that's completely changed.